Now we can finally get started with timing our entries and looking at the first setup that we trade here in this course. And the first setup is called our swing reversal. It is a very basic swing pattern and a very basic swing reversal pattern. And you won't be able to explain all the reversals and all the transitioning periods, but that is totally fine. We will start building our foundation now, and then once we get into the next two modules where we explore our trap pattern, the squeeze, and also our trend line shift and the trend line transition, by the end of this course, you will then have a very solid foundation where you'll be able to understand and trade most of the reversals and the transitioning periods that happen on the markets, and especially the high probability ones. So let's get started with the swing reversal. We have learned all the tools by now. We know the market selection, that we always need a trend with multiple trend waves. We need a fading momentum signal and a strong break of our local structures or the moving average. And so now let's get started and take a look at a few examples, and I will mark also the potential entry here for you on the different reversal and swing reversal setups. So we are here in a short-term trend. You can see we are moving lower here. We have multiple trend waves, which is our first criteria. And now we are just looking for the transition point. Where are we breaking the moving average? And in that case, it happened here. It didn't happen here. And this is a very important first lesson, is that we do not make mid-candle decisions in our trading, which means that you can see here that price penetrated the moving average. We moved higher above the moving average during the duration of the candle. We never fully closed above the moving average, and so this is very different from other people's trading, where they impulsively jump on trades as long as the candle still forms. We have found that the quality in the trading and the trading strategy can improve significantly if you just make candle close decisions and stay away from candles that are still in the process of forming. So this one would have been a failed signal and not a real one, because we never really closed above the moving average. You can see price kept on trading lower. We have here something like a double bottom or a triple bottom here. We broke here below the lows, and then we made another double bottom. At the same time, we can see that we have some type of RSI divergence. The RSI is making a higher lows already, and the price is still making lower highs. So we have a very good confirmation here that the trend is really losing momentum. Then we can see, if we zoom out a little bit, that the reversal seems to be happening right at this previous reaction point, which is the low here of this candle, which then marked the complete turnaround in the opposite direction. So an important turning point. We can also see we have something like a flip zone here, where here's been support and resistance, then support, so important area here as well. And it's a good confluence that our reversal is happening or starting at that point. And then we can see here price is starting to make a run at the moving average. Here we don't close above it. Then we have two candles that then slowly crawl above the moving average, and you can see the candles are not as strong. So if you are not fully convinced by the first one, you can wait one more candle. If you are not fully convinced yet, then you can wait even one more candle. So each one of those candles could have been a valid entry signal, depending on how you want to get into a trade. If you are a little bit more on the risk-seeking side, you can definitely get in here, because at that point we are already making higher lows. You can see that, or higher highs, better said. You can see we have been here resistance, then here some type of resistance. This is an important flip zone, as we will learn later. You can see resistance then turns into support. We break above this area and then confirm our new trend direction. So either one of those three little candles can be an entry signal. Of course, the longer you wait, the higher the chances are that you just get a runaway trade and you miss the trade. But you get the idea that you need a break off the moving average. You preferably need a trade or a break above the previous swing highs that then confirms that we are changing the market direction. And that's how you could get into such a trade, with combining the different entry criteria. Here's another example. We are here in a downtrend. Again, we are staying below the moving average, which is a very important criteria in our first swing reversal pattern. We want to see a trend where price has stayed below the moving average for quite some time, and you also want to see that price is pulling away from the moving average, which shows that the momentum is high, and that is a good criteria for a trade. And again, we always look left to see if we can get confluence. So here, for example, we have some type of support zone. In that support zone, we even have a little demand zone, if you remember that. Here, very small consolidation before we then shot up in a very strong way. So a good confluence here as well on this short reversal, or in this long reversal better. And then in that case, we do not have a RSI divergence. You can see when we zoom in, the RSI was making lower lows, and so was price. So that is not a RSI divergence, but it's not a problem. It is not a must-have criteria. And below this video, I will also put a checklist for you that you can use, download it, print it out, put it next to you in your own trading. And then you will see in the checklist there are different criteria. We separate between must-have criteria and other add-on criterias. And you can see how you can use the checklist then to form better trades, to get into better trades, and also to help you make sure that you avoid bad trades where you should not be in. And that is what a checklist comes in very handy. Then here, when we just look at the price structure, you can see we have head and shoulders, left shoulder, head, right shoulder, and the head and shoulders is confirmed here. Once we break higher, once we move away from this right shoulder and we break above the moving average with a very nice candle here, a strong break of the moving average. It is the first time that we fully close above the moving average here in quite some time. After we've turned around here, we have the confirmation that price is now making higher highs here. And also we can see that here is the previous swing high. You can see that here on those two candles. We break above this. We are also here at this important area. You can see that here, previous swing high as well. Then we break above it with our candle that breaks the moving average, and then we start a new rally. So again, you can see how we can combine the different confluence factors here. And the swing pattern is a very high probability trade, although you are looking for some very specific things which do not happen all the time, but if it happens, they can get you into good trades. And to get into more trades, that's when we then look at our second and our third trade pattern, which will then help you get into different types of reversals and analyze different types of markets. But this is a very good starting point, especially for beginning traders who get into transitioning periods and transitioning trading, because it helps you understand those transitioning areas, what is happening here exactly, how are the buyers and sellers shifting, how is the buyer and seller dynamic shifting, and then when is the point where we finally make the transition from a downtrend to an uptrend. And that is a very important starting point on your way to becoming a good reversal trader. Then here at the top, we move just right back into a trend. Here you can see we are staying above the moving average, we are pulling away. Then here we do have some type of double top, another structure if you remember that from our previous video. And at the same time, we are here in a very important resistance area. You can see that here we have a lot of swing highs here. Price is moving back into this area. You can see a reaction point, swing highs, here a lot of reactions as well, and here price is in this area as well. So interesting confluence here right away. We have the double top, we have our resistance confluence, and then price suddenly picks up momentum. You can see that we break here below the moving average, which is also now below our recent swing low. You can see that here we had a lot of support in that area. We broke below it, and here was the initial entry. You can see we did not immediately pull away, and we moved back into this area, which is a very common pattern. It is called our retest or flip zone, and in the later module you will see how to trade the retest pattern. But if we want to just take a look ahead, then we can see that a retest is confirmed once we break away from the retest area, which in this case is the previous support and resistance area, also the moving average. So there are two ways of getting into such a trade: the initial high momentum break or the retest and the confirmed retest then. And you can see that afterwards price broke lower and started a new very nice downtrend. Here then another very nice example. You can see we had been in a very strong trending market, and then price just drifts sideways. You never have a really strong break of the moving average. You can argue here is your entry point on the break of the moving average, which is not a bad place to get into such a trade. But then again, you can see that price hovers sideways for multiple candles, Remember, that's the 4-hour chart, so that is probably going to be around 1.5 or 2 days. So you have 2 days where you don't get a follow through. If you enter here with the idea that price is going to reverse, especially after such a high momentum candle, and you don't get the follow through, price just drifts sideways, then this is a very bad signal. You have to get out of such a trade. You have to cut it because the price action is not agreeing with your trade. If you want to get into a long trade and you don't see an immediate follow through, then you should get out of your trade. And that is the same what happened here. If you enter short here, you don't get the follow through. There's nothing wrong with cutting your trade here and then waiting for the re-entry opportunity, which happened here. And that is a very important trade management principle that we will get into later as well. Let's take a look at a few more markets and a few more examples. So here we are on a different market. You can see we have been in a clear uptrend, but as I said in the previous video, here we have very wide swings. Price is not respecting the moving average at all. So in that case, if we are looking for a swing reversal trade, this is not going to give us an entry, because once we see that price is always violating the moving average, we are not going to trade such a market. There are different patterns, especially the trend line shift, which is the third pattern, can help us get into such trades if we see that there's a high probability setup. But for now, we just stay away if we see such a trade or such a market. And then we enter a nice trending market. Again, you can see here we have here a rally. Price is pulling away from the moving average. We have multiple trend waves here into the direction of the trade, into the direction of the trend. You can see that we are entering something like a previous resistance area here. Lots of confluence in that area. Price is moving in this area, and then suddenly we find a lot of bearish momentum. We break the moving average here in a very strong candle here, and that is then your entry criteria. You can see we don't immediately pull away, but it is just 1, 2, 3 candles, which is not bad. And 3 candles on 3 sideways candles on a 4-hour chart are not big enough reason to get out of such a trade. Especially it depends on where those candles happen. Probably those candles happen during a very active trading session, and then here during a more inactive session you just have a sideways movement, which is not bad. It is not going against your trade, and so you stick around and then you see the follow through into a very nice downtrend. Then at the same time we then move into a downtrend here, and we have 1, 2, 3 trend waves. We have our consolidation at the bottom. Eventually we break higher. Here we just close at the moving average, which is not ideal. So we would wait 1 more candle until we see that price is breaking above the moving average. Again, we don't have a follow through. Price is just drifting sideways. Here it is going against us a little bit. And so there's nothing wrong with cutting your trade if you want to get out of such a trade. Later I will also discuss the set and forget approach, which is another way of a more advanced trade management strategy. So we'll get into that as well. And then here again we have our retest pattern, which we will cover later. And you can see that price is moving back into this area, very high impact resistance area, very important resistance area, which is now becoming support. We are pulling away then here from the resistance area, which is then confirmed, which is then a confirmed retest. So you could have gotten into this trade at a later point again with a re-entry opportunity and then capitalize on such an uptrend potentially. So again, there are many ways to play the trade, and I just want to highlight a few different ways to enter such a market, what to look for, the structure, the different confluence factors, and then over time you will be able to build up your own playbook. You will be able to understand such markets. When do we have a valid retest? When should we get out of such a trade when it moves against us? How to get into trades again at a later point, and so on. Let's look at a few more examples, and by then it should be clear what we are doing here. So here we have a little bit of a different structure. You can see we are here in a downtrend. This is not ideal. We have 1, maybe 2 trend waves, not 3 definitely, but we have 2. And then here at the bottom, price is finally turning. We are here in a very important support and resistance area, which is adding confluence to our trade. You can see price is not finding immediate support, and that is totally fine. We are not trying to pick the absolute top and the bottom, and so we just wait until price is turning around. And here we can then see price has a high momentum break of the moving average. We are also making higher highs now. At that point you can see that here we have the transitioning from lower highs to higher lows and higher highs, and then we have the high momentum break. Again, we don't see an immediate follow through, but we don't also see that price is majorly going against our trade. And again, we have 3 or 4 candles on the 4-hour chart, which is not too bad. So not a very big reason to get out of such a trade. And then you can see that here we have a follow through again. And then this follow through leads into a new bullish market, 1, 2, 3, 4 trend waves, very nice trend structure. Again, you can see we don't immediately break the moving average here. You can see here we are just crawling sideways. So what happens here is that it is not price breaking the moving average, but this long consolidation, this long range gives the moving average the time to pick up with price. So in that case, the moving average is coming up to meet price, and it is not priced to come down to meet the moving average, and this is two very different things. So such a market would be more tricky to trade if you decide to stay away. Nothing wrong with that. You can see we had our break here eventually, where we made lower lows at that point here. Once price closed the red candle, the long candle, and broke below the lows, you can see that we had a short reaction. We moved back against the trade, and then we had another run lower. So this might have been tricky to manage, but nevertheless, this was a valid entry signal. And if you are following the set and forget approach, which we will learn in the later modules, then you could have made a profit potentially on such a trade as well. And again, not all the setups are textbook. And it is important that you understand the different types of markets, of trends, and also of reversals, so that once you are in the live markets, you're trying to make live trading decisions, you're not surprised when then suddenly the trades, they don't look like textbook reversals. And it's important to understand the different shapes and forms that reversals can have. Let's look at one more example. So here we are in an uptrend. You can see 1, 2 trend waves. Then here suddenly we have a break of the moving average, which is a high momentum break. We are breaking below the previous lows. You can see that here very clearly. Let's look left, and we can see that we are here in this supply zone, very high impact reversal area. So if you take a short here, there's nothing wrong with that. At that point, you also have your RSI divergence here. And again, not all the setups and not all the signals will work out. It is important to understand that. And then you are not surprised then if you have some losing trades. That will happen to everybody, regardless of how well you trade. Not all the trades will work out. But the good thing about this trading strategy is that you will always, or almost always, get a re-entry opportunity or a second chance. So here you can see price kept on trading. We made a higher high. At that point, we even more interestingly now broke above the previous reaction point. You can see that here was the high, then price broke above it. We immediately reversed here to the downside. We had our next break of the moving average here with a very high momentum candle. Again, we moved sideways for quite some time. So depending on how you want to play that, if you're following the set and forget approach, which is something that we recommend in the beginning, and I will come back to that later, then you would just wait it out and see what happens. If you want to cut your loss, then there's nothing wrong with that as well. You can get into such a trade at a later point probably. And then you can see that here we have another very important retest pattern. So you can see that we have a very important support here, multiple support touches, support. Then we come back into this area, we retest it successfully. And don't worry if you don't get it right away. We'll spend an entire lesson or multiple lessons on the retest pattern because it is such an important concept. And then here again, you can see once price pulls away from this area, you have a confirmed retest and you can get back into such a trade. And then this time you can see you could have realized a very big winning trade. And most often those re-entry opportunities, they then provide trading opportunities where you can make up for the previous losses, often very comfortably. So it is important to know about the different nuances of such a market and understand the different concepts. Here, the fake breakout, which would have probably been a loss for everybody. Although you can already see that here was a gap, and this was then probably a Friday night gap. You can see that price closed here on Monday morning. We opened here. It is something we will get into later again, and why we don't hold trades over the weekend. And then here, Another important break here, you could have gotten out of a trade, you didn't have to, and then here the final re-entry opportunity, which then finally would have made up for the previous losses and could have gotten you back on track and your account as well. So again, that is just the first lesson of how to get into trades, and we will spend a lot of more time going forward to look at different setups, look at different trades, how to get into trades, how to time the market. And of course, you can also always go to our forum.